In this video we're going to look at the risks involved in short selling, and hopefully this will act as a warning to you and will improve your investing. So the first thing to know about the risks of short selling is that your position moves against you. So as you lose money, your position is getting bigger and representing a higher proportion of the portfolio. And as the position represents a higher proportion of the portfolio, it has a higher total value, you have to hold more capital to meet the margin requirements because you're borrowing those shares and it's going to cost you more to buy them back. So you have to prove to the person lending to you that you're able to do this. And you can't deploy the extra capital elsewhere. So it's damaging your asset allocation, and you're also risking a margin call. Since this position's got bigger, you're more of a risk to the broker or the lender, so they may ask you to hold more money or sell other positions at prices that you don't want to sell at. There is, in theory, unlimited risk involved in short selling. I say unlimited, but of course it's technically not unlimited. The problem is that stocks can go up and up and up, and some of them have gone through the roof. And this hurts short sellers a lot. You can potentially lose far more than you invest. You can take a short position of $1,000 and you can lose $10,000. It's quite risky. Because you see, stocks can only drop 100%, they go to zero. With limited liability, stock prices don't go negative. But they can rise 1,000%. This has happened. And can you imagine if your short position went up 1,000%, you're in trouble. Also, fundamentally, being a short seller is a contrarian strategy, and being a contrarian is difficult. You see that the general trend of markets is upwards. You're betting in the opposite direction to where markets usually go over the longer term. You'll find that markets are somewhat efficient, so doing very, very dumb things doesn't work, and you have to be smarter than everybody else to be a successful short seller. And important to remember the great Keynes quote, "The market can remain irrational longer than you can remain solvent." People short selling companies in the dot-com bubble found this out and lost a lot of money. You've also got things like short squeezes, which some people don't even know about, but they're extremely important for short sellers, because you can be forced under certain circumstances to buy back your shares to close your short position at unfavourable prices. So things like takeovers can act as short squeezes. They coincide with a jump in price. Why is this? Because upsurge in buy orders. When the short sellers are being squeezed out, they have to close all their positions, they have to buy all this stock, and if a stock is heavily short sold, all these people have to rush into the market to get the stocks, which drives up the price. You will lose money very quickly in a short squeeze. They are to be avoided, they're dangerous. Also, short selling is short term, which is more difficult in an investing sense. You find that good results are only possible as a short-term investor in short selling. That's because it can only go down 100%. So if you look over 10 years as a short position, the compounding rate is quite low, and you're not getting dividends from that short position. You're getting dividends from the proceeds of your short selling, but the asset allocation of that collateral is restricted. Also, short selling is both intrinsically leveraged and can have additional leverage. And you find that leverage is just intrinsically risky. A great Warren Buffett quote is that no one ever went bust who didn't owe money. You're risking your returns by taking leverage. You're taking on the risk of having extraordinarily bad returns, because leverage can multiply your losses dramatically when things go wrong, and can wipe out your compounding base very quickly. And if you imagine combining a leveraged position with a short squeeze, you can just see how much money you can potentially lose in such a short space of time. Which brings me to blowing up spectacularly. A great example of this, just as a general warning, it's not just about short selling, but long-term capital management. There's some very good books on that. If you're thinking about doing overly clever things in the market, this book acts as a warning to that. So please look that up. You find also that a small mistake in short selling, so if you're wildly shorting things and you get one of them wrong, your returns are virtually gone. Making a 200% loss in a portfolio that's going up between 10 and 15% a year is catastrophic, and it's reducing your compounding base early on. So over the next 20 years you've got a permanent loss of capital at year 1, so your compounding is reduced. So in general I say stay away from short selling, but other people respond, I'll just use a stop loss, and I think this is some magic solution. It's not, because it's increasing your emphasis on market timing, which people are very bad at. You're unable to tolerate volatility, so not only are you short stock, you're also being short volatility. And if you read Nassim Taleb, you'll find out this is a fragile way to be. You're against volatility. Volatility harms you. That's not a very good place to be. You would rather have volatility be your friend than your enemy. So basically, it's only for the most sophisticated investors. Discount brokerages are very happy to take your money, but really, if you're using a discount broker, you're not the sort of person who should be short selling. It is a very high risk strategy. So basically, I'd say almost everyone should avoid short selling. It's dangerous. So please take note of this warning, and thank you for watching.